evening, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend and that you were out enjoying the nice weather, at least the nice weather we had here in lovely Cleveland, Ohio. Going to jump right into the two things that grabbed our attention recently. We've been off a few weeks from doing it, so it's good to have everyone back, and we're going to kind of jump back into the schedule. So the first thing here, was something we tweeted last night, which was when we said that 2+ almost 3 months ago now, that the Fed would have to begin injecting dollar liquidity in order to prevent themselves, or basically to prevent losing control of the price of money in the U.S. It was a bit of a controversial call. We were ridiculed by some, but we think it's really interesting. Now in the past week or so, you've seen both Bank of America and JP Morgan calling for QE by the end of this year, which was a call. It was actually the cover of the first report we issued in our main FFTT subscription back on January 4th or 5th of this year, that the key question for this year is when would the Fed's balance sheet begin growing again. We thought at that point it would be no later than end of 1Q20. More likely it would be before the end of 2019. And so, we have some very thoughtful people joining us. And so in that view, which I think is an important milestone, the quote that was in the Bank of America piece, regardless, it would represent the Fed permanently buying treasuries outright to maintain control of funding markets well above the zero lower bound. Key word there, permanently buying treasuries. Federal deficits are never going to stop growing. That's just the nature of the beast. That assumes no recession. If the Fed is needing to buy more treasuries again to control the price of money in the U.S., this is unlikely to be a one-time thing. And so I think it's very important to understand that word, permanently. So that's the first thing that grabbed our attention. Second thing, also something we tweeted last night, an article noting why is the euro rallying on risk off, which was, we thought, grabbed our attention right away because it was something I noticed last week. Watched the markets off big on Monday, euro was up, dollar was down. Markets opened up down big on Wednesday, euro was up, dollar was down. Markets opened down fairly big on Friday, euro was up, dollar was down. That is a very big non sequitur to where most people are positioned and what most people believe, which is big risk off, dollar up. I think it's a subtle but important hint here. So it would suggest that the euro is increasingly a funding currency. In other words, people are borrowing in euro and buying other currencies or other assets in other currencies. And if we can infer that from the action of the euro rising and risk off, we can infer some pretty important pieces of information. First off, if you're borrowing in euro and buying other assets for carry, one could infer that you're probably doing some buying in dollars. And so the question, it's an interesting inference. If you're borrowing in euro, buying in dollars, or that has taken place up to this point, you can infer this very interesting point, which is that the negative rates in the Eurozone and QE in the Eurozone didn't just save the Eurozone, they saved the U.S. Remember, global central banks stopped buying treasuries on a net basis 5 years ago. It's been the global private sector picking up that slack ever since. And it would seem perhaps aided by the zero or negative interest rate policy in the Eurozone. So we're watching anything that happens there on the funding side of that trade closely, because if anything strengthens the euro or increases German in particular, but European rates broadly, the other side of that trade that would have to get fixed would be selling dollars, selling treasuries, at least in part. So I think that broader point, there's a great point in Michael Lewis's book, The Big Short, where they talk about two men fighting to the death in a small boat in the middle of the ocean. One finally clubs the other over the head, kills him, throws him overboard, only to find that he's tied to the waist to the man he just threw overboard. And I think when we think about dollar, euro, yuan in particular, those big three within the SDR, there's a lot of talk about who's going to go overboard first. And our case all along has been the rope connecting all three of them is much shorter than people think. So we're going to jump into a few questions here. First off, from David, was the devalued yuan just a warning shot across the bow, and what if we see more devaluations, market consequences, etc.? Yeah, I think it was a shot across the bow. In part, I think there are also possibly some market forces there. I think the more you internationalize the yuan, the more the yuan is used in trade, the more yuan supply there's going to be. There's not a lot of incipient yuan demand from yuan debt outstanding yet to soak that up, and so that will put downward pressure on the yuan. So ultimately, if the yuan starts signing up big trade partners, or if the Chinese start signing up big trade partners to do more business in yuan, ironically, the first thing that will happen is the yuan will weaken. So we want to look more into that and just not jump right to conclusions. But the bigger message to me of last week was U.S. markets exist by the grace of the PBOC. Seems like, doesn't it? The PBOC weakens just the yuan just a little bit, and the Dow goes down 1,000 points. Are you kidding me? I think it's I think it was an important warning shot. Secondly, from Yalim. Previously, you mentioned that whenever yuan approaches to 7 against the dollar, Western vaults, particularly London and U.S., bleed gold. Recently, you indicated that this correlation has changed. Any insights on why? Great question. Yes, the correlation has changed, sort of. London is still sending gold in May and June as the yuan weakened towards 7, was still bleeding gold. However, for the first time in 3 years, gold's price actually responded. Up until now, there's been this peg where the gold moves out of London, out of the U.S., generally flowing east, and the price doesn't really move. It stays between 1,200 and 1,350. For the first time in 3+ years, and arguably 6 years in some cases, the movement of physical gold east out of London has actually driven the price higher. Wow. Fundamentals may be starting to actually matter for physical markets. And, we've always said that, physical fundamentals aren't going to matter until they matter. And so for us, maybe they're starting to matter. Why? I don't know at this point, but we have definitely noticed this correlation has started to change, and so we're paying close attention. Third, Rob, I'm looking for someone to share the facts on exactly who other than central banks buys negative yielding bonds. I'm sure the buyers are not irrational, so who are they and what is their motivation? Great question. I think part of it is bank liquidity requirements under Basel III, where they have to hold a certain amount of capital, and that capital is defined under Basel III largely as government bonds. I think a bigger portion of it, and if you listen to the Investors podcast we did about a month or a month and a half ago, I would check that out. We were asked about that. FX hedging markets are incenting otherwise perverse behavior. So, for example, to be brief, as an American investor, I could sell euro forward, buy German bunds, which are yielding, negative 25 or 30 or 40 basis points, and I could actually earn a positive, I want to say like 2.5, 2.6% yield on that German debt. And so by virtue of the currency market, the currency hedging markets. And so I think most everyone, I don't want to be sloppy with my language, most everyone is quoting all of these yield numbers in nominal numbers, but I think it's important to quote these numbers in FX hedged terms, because once you adjust for the cost of hedging FX risk, the yields are still positive for certain areas. So Eurozone, maybe yen, I don't know that, but notably they're still negative, and notably negative for the dollar, for dollar denominated debt. And then last, Brian, possible near-term spike in dollar as evidenced by copper breakdown, EM breakdown, and near breakdown of oil this week. No, you've had the opposite view. Spike high possible first. We've been saying we concede readily that you could see a super spike higher. We just don't think it can last for very long, and it may not be investable if you've got, for traders or institutional funds, just based on, for example, what we saw in the end of 4Q18, first part of this year, but would readily concede that and certainly paying close attention. One last question from Jesse, just a one-word question mark. Epstein, what do we think? I'm not going to get into any of the politics or what have you, or the speculation. I will say this: the thing that fascinated me most about this weekend as it relates to the death of Epstein has been that parties that have generally looked down their nose at critical thinking conspiracy theorists. They've denigrated critical thinking at times as conspiracy theorists. We're fully engaged in conspiracy theory all weekend long, and so to me, I just think it's a very interesting potential mile marker where once you open that Pandora's box of sort of crossing a bridge too far, where even parties that have been very reticent to engage in any speculative critical thinking, aka conspiracy theory about events, once they're engaged, I think it's a potentially important milestone. So I am going to jump at this point. As always, check out FFTT-LLC.com for updates on where we are, information on tree rings, and otherwise, everybody have a great rest of the weekend, and look forward to catching up with you all soon. Take care.